But largely throughout the year, we have seen that the IT pack has been under tremendous pressure. To understand how things are working out for the sector, we have with us Mr. Abhishek Bhandari, the Senior Equity Analyst at Nomura. Abhishek, hi, good afternoon. Thank you so much for making time and speaking with us. First, I wanted to understand from you, we are getting a bit of glass half full, glass half empty sort of situation for the IT sector. While the managements continue to say that nothing has really changed and demand outlook is quite strong, the street is definitely not believing that. And in fact, a lot of people are expecting more downgrades to come by. What's your take?
Thank you for having me on your show. So look, we downgraded the sector sometime in May. We remain very cautious. And our thesis is very simple. Investors are likely to get disappointed on margins in FY23 and on growth for FY24. In the very near term, which is the rest of this fiscal year, the companies are sitting on good, order book. Some of the deal wins, which they have won in the past are getting executed quite well. But in the May report, we did do an empirical study of, Fortune 2000 companies, and we found a very strong correlation between their revenue growth rate and the Indian IT services growth rate with some lag. And to our surprise, when we wrote the report, since then we are seeing a material, reduction in the revenue forecast for those underlying companies. So in short, I think in the very near term, maybe for a quarter or two, you may not see too much of disappointment on revenue, but for the next year, definitely the uncertainty on revenue is much higher.
Right. A lot of mid-cap names have done well, Abhishek. And, when we just look at mid-cap names, their size is now particularly quite strong. Do you expect that they will be able to outperform the industry growth?
See, thank you, Pankaj, for that. If you look at it from a Q1 perspective, definitely, their performance was better than most of the large caps, despite the salary hikes what they have taken. Partly, because they have less exposure to, Europe compared to the large caps, which is aiding both in terms of lower, cross-currency headwind, as well as, better revenue visibility. Having said that, from a longer term perspective, mid caps definitely have an edge in terms of growth compared to the large caps, given the size and given some of the niche where they're working on. And I do see that trend continuing even in FY23 and beyond, that, the mid caps will grow at a multiple of the large caps and the overall industry.
The other trend, Abhishek, that we have been talking about for a while is that how some of these niche IT companies have made a different space for themselves, whether it's KPIT Tech or Tata Elxsi, which was doing quite well, at least at the start of the year. Do you think that is how the entire sector will evolve? And also, if you can talk to us about what is your pecking order in the sector in terms of stock recommendations?
Sure. I can't really speak about the two names you mentioned since I don't cover them. But look, mid caps have their own niche. Some of the mid caps, have tried to find an area where they're able to get a growth, which is much better than the overall industry. If you look at Persistent in particular, which we cover, the company has been able to do almost 25% kind of organic growth year on year, significantly higher than the peers. So clearly, there are certain pockets in the mid caps where the growth performance will remain disproportionately better compared to the rest of their own peers, and definitely, much better than the large cap names. Among the stocks, what we cover in the large caps, we prefer Infi and TechM. Infi because we think, their growth performance will continue to outpace the peer set even in FY23. And particularly, with reference to TCS, which is normally compared with Infi, we see this will be the fourth year where they will continue to grow faster than, TCS. And TechM is more of a valuation call, given, where they are. In the mid caps, we are slightly cautious, both in terms of, valuations, and also we think typically in a downgrade cycle, the volatility in performance of mid caps, tends to be very high. And the only buy rated stock what we have in mid caps is Persistent.
Abhishek, you are talking about on one hand how mid caps are likely to outperform the large caps, and on the other hand, you are cautious when it comes to your recommendations. Could you explain that a bit more?
Sure. Typically, when the industry goes through a slowdown, there are chances of client-specific issues or, some certain projects getting ramped down and things of those sort. And the negative impact of those tends to get magnified for mid caps compared to large caps, given that mid caps have disproportionate, revenues coming from their top clients. So that is, one of the biggest, considerations in, keeping that cautious stance. And of course, if you look at the valuations, while most of the broader sector has corrected, so have the mid cap, but compared to their long-term history, the premium at which most of the mid caps are trading at is significantly higher than large caps. Large caps might be trading at close to 15 to 20% premium to their long-term averages. Mid caps are trading anywhere between 30 to 50%, premium to the long-term averages. So I think it's a factor of these two which makes us cautious.
All right, got the point. But just wanted to say that, IT companies have given great buybacks, they've given great dividends, constantly growing. Any correction in the larger ones would be an opportunity to add?
Definitely, I think if you see the stocks coming down towards their pre-COVID multiples, I think the risk reward becomes fairly compelling. That is kind of around a 15 to 15% kind of correction from here, and clearly that will make them very attractive from a risk reward thing. And also keep in mind, as you rightly said, most of the large caps have been flushing out a good amount of dividends and buyback to the shareholders, and the free cash flow yield for some of the companies like TCS is almost equal to their earnings yield, because they almost give out everything. So yes, a disproportionate fall in some of the frontline names is definitely one can consider from an investment point.
Got the point. Thanks so much for taking out time for us, Abhishek. Hope to see you again quite soon.